Here's a strange investment puzzle. You put $100,000 into an ETF paying a 12% yield. Over the next year, it sends you $12,000. But while those payments arrive, your shares fall to $84,000. You now have $96,000 total. You were paid every month, and you still ended up poorer. The payment was real. The conclusion you probably drew from it wasn't. And that gap is exactly where QYLD, XYLD, JEPI, and half the high-yield income funds in your portfolio are quietly working against you. I'm Amy. I analyze investments by tracking where the money actually came from, not the percentage printed at the top of the page. So we're going to run QYLD, XYLD, and JEPI through three numbers that matter more than yield. First, the trap hiding in the math itself. Then which of these funds actually protects you and which one only pretends to. And near the end, a mechanism most investors have never heard of. The reason some of these funds struggle to recover even after the market bounces back. Stick around for that one. Covered call ETFs solve an emotional problem extremely well. Markets feel uncertain. A monthly distribution feels concrete. It lands in your account like rent. But your statement shows only the cash that arrived. It doesn't notify you about the upside you surrendered to get it. Yield is visible. Opportunity cost is invisible. To know whether the trade helped you, you need to see what the fund sold to pay you. A covered call ETF holds a basket of stocks and sells call options against them every month. In plain English, it accepts cash today in exchange for handing someone else part of tomorrow's upside. Sideways market, the option expires worthless, the fund keeps the premium, almost no upside lost. Falling market, the premium cushions the drop, but only a cushion, never a floor. Rising market, the fund hits its cap and part of the gain now belongs to whoever bought the option. This isn't stocks plus free income, it's future upside converted into cash today. That can be a reasonable trade. The problem starts when investors count the cash and never measure what they gave up for it. I'm using QYLD and XYLD as the main test cases here because they're two of the oldest funds in this category. Enough real history to actually test the claim instead of the 2 or 3 years most newer funds have on the clock. Since QYLD launched in December 2013, its total return, every distribution reinvested, is up 179%. QQQ, the index it's built on, is up 841% over the identical window. Here's the concrete version. $10,000 into QYLD at launch, distributions taken as cash, the way most income investors actually use it, $11,100 collected, plus $7,300 left in the account. Total, $18,400. The same $10,000 in QQQ, same treatment, $87,600. Now, a QYLD investor has a fair objection here. QYLD was never designed to beat QQQ. Correct. That's the first reversal. This comparison proves the cost of the surrendered upside. It doesn't prove QYLD failed at its actual job. So the real question isn't whether it underperforms in a bull run. It's whether giving up that upside bought real protection when the market fell. And this isn't only a 12-year story, just the last 3 years. QYLD is up 47%, QQQ is up 91%, nearly double over a much shorter window. JEPQ, a newer fund that launched in 2022 and sells its calls further from the current price, narrowed that gap to 69% versus QQQ's 91%. Better, but still a wide gap. One caveat that matters. Those 3 years include one of the strongest AI-driven bull runs in market history. In a flatter or falling market, the conditions this strategy is actually built for, this comparison would look very different. Before we answer whether the upside was worth it, look at how a shrinking share price can make a yield look stronger even as the payment shrinks. A fund paying $2 on a $20 share yields 10%. If the payment drops to $1.60, but the share price drops to $14, the displayed yield rises above 11%. You received fewer dollars. Your shares are worth less. The yield looks better. That's the denominator trap. QYLD's own share price is down 27% since inception, which is part of why a 12% yield can sit on top of a shrinking pile of money. So, did giving up the upside actually buy protection? JEPI's worst drawdown since launch was 14%, while the S&P 500 fell 25% over that same stretch. Real cushioning. XYLD's worst drawdown over its own lifetime was 33.5%. The S&P 500's over that identical window, 33.7%. Almost identical. That's the worst version of this trade. You gave up most of the upside and kept nearly all of the downside, and it exposes a mistake in treating these funds as interchangeable. QYLD and XYLD systematically write index calls across essentially the full portfolio every month, no exceptions. JEPI and its newer Nasdaq sibling JEPQ pair a more defensive stock selection with options sold further from the current price, leaving more room for the shares to rise before the cap kicks in, which is part of why JEPQ narrowed that 3-year gap earlier. Even newer funds like SPYI and QQQI, launched in 2022 and 2024, use different option structures aimed at more tax-efficient income. Too new to backtest properly yet, but worth watching. The single-stock, ultra-high yield funds are different again. More concentrated, often built with synthetic option structures instead of holding the shares outright. And their distributions can swing hard month to month. Comparing them by yield alone is like comparing a minivan and a motorcycle by fuel tank size. The lower yield fund can be the better income fund if it actually preserves more capital. At this point, people usually blame return of capital. They see ROC on a distribution notice and assume the fund is just handing back their own money. Sometimes that comes with a real problem, but the label alone doesn't prove it. It's also a tax classification, reducing cost basis instead of triggering tax right away. So don't just ask, did this include return of capital? Ask, after adding every distribution back, did my total wealth grow? And did the fund deliver the protection I bought it for? Return of capital beside a stable NAV is a different story than return of capital beside one that keeps eroding. The tax label isn't the verdict, the economic result is. Here's the mechanism almost nobody talks about. Imagine the market drops sharply this month. The option premium softens the fall, but the fund still loses real value. Next month, the strategy sells a new call, based on the market's now lower level. Then the market rebounds. A plain index fund participates fully. The covered call fund can hit that new lower strike price and hand back part of the recovery too. It absorbs much of the fall and captures only part of the bounce. This won't happen in every decline. It depends on strike distance, override percentage, volatility, and timing. But it's a real reason some full override funds struggle to rebuild NAV after repeated sell-offs. Downside arrives in one piece, upside gets clipped back in installments. So avoid every covered call ETF? No. Stop asking whether the fund is good and decide what job you're hiring it to do. For growth, compare total return with the underlying index, every distribution included. A full override fund starts that race with a structural disadvantage. For cash flow, add every distributed dollar to the value of your remaining shares and check whether the payment is stable in dollars, not just as a shrinking percentage. For a smoother ride, compare the fund's actual drawdown to the benchmark over the identical window, not a mismatched one. The question isn't how much does this ETF pay? It's what did this ETF have to sell in order to pay me? Covered call ETFs aren't fake income. They're a trade, future upside, converted into visible cash today. For the right investor in the right fund, that can genuinely work. But the check is only one side of it. The bill can show up as slower growth, a declining NAV, weak crash protection, or a recovery that never quite catches up. So next time a distribution lands, don't just ask how much you were paid. Ask what you gave up to receive it. Comment with the ticker you want tested next, and whether you hold it for income, safety, or growth.